currencies and so I was talking about this accounting standard, which you can get on the website of Institute of Chartered Accountants of India. And here in this accounting standard, we can see that it applies for the accounting for transactions in foreign currencies and in translating the financial statement of foreign operations. So going ahead in this, so it has some definitions. So what is a foreign currency? What is exchange rate? What is closing rate? Right. So like this you can do. Then so let's read this through. Sorry, 1 minute. Yeah. So foreign currency transaction is a transaction which is denominated or require settlement in a foreign currency. Include transaction arising when an enterprise either buys or sells goods or services whose price is denominated in a foreign currency. Like for example, any entity in India is buying some goods or services in dollar or in euro or in pound or any other currency. So this is first category A talks about normal buying and selling of goods. Point number B talks about any loan, like if I have taken any foreign currency loan, borrows or lends funds with the amount payable or receivable are denominated in a foreign currency. I have taken some foreign currency loan or have given some foreign currency loan, that is also governed by the foreign exchange fluctuation accounting standard. Then become a party of unperformed. So let's not cover this. This is a very complex subject. Let's not do it in this class. And then moving on, mainly these two, A and B, are more relevant for you. And here in B, we are also talking about trade payable and trade receivables, which are there in the foreign currency. So if we read point number 9, foreign currency transaction should be recorded on initial recognition in the reporting currency by applying to the foreign currency amount the exchange rate between the reporting currency and the foreign currency as at the date of the transaction. That means when we are doing the transaction on that date, the whatever is the relevant exchange rate, my transaction should be recorded at that rate. So when we are doing it, so in SAP also, so when I am doing any foreign currency transaction, whatever is the exchange rate which is fed into the system on the basis of the posting date, so that is automatically picked up and the transaction is booked on that exchange rate. I'll show you in further during the session, but posting date is the most important thing here. When we are booking any entry, I am booking any sale in foreign currency or I am booking any purchase in foreign currency, then transaction will be posted using the exchange rate prevailing at the posting date. Prevailing means it has to be fed in the system. System cannot decide on its own. Somebody has to feed in the system. Either it is a direct feed through some interface, or we have to put it manually. Then moving on. So this we are talking about reporting at subsequent balance sheet date. So when I have done the booking, right? And then when I come to the next period end, maybe it might be a month end, it might be a year end. So you can see in number A, foreign currency monetary items should be reported using the closing rate. Closing rate means whatever is the rate which I have prevailing on the closing, like 31st March, sorry, 31st March is the closing of my financial year. So I will feed the exchange rate of 31st March in the system, and system will automatically pass. SAP will automatically pass the entry for the revaluation. And revaluation, it will compare the rate on which I have booked the transaction. So for example, my exchange rate INR versus dollar is 90. So when I have posted the transaction, then it has recorded the expense and it has recorded the vendor liability at 90 rupees per dollar. But when I come to 31st March, suppose INR appreciates and the exchange rate becomes 89. So system will automatically pass this entry of revaluation. So because 1000 INR has appreciated, so it is an exchange gain. So it will create one entry and it will debit to the vendor control account. It will not debit to the actual vendor account because vendor has nothing to do with it. Exchange rate revaluation is your internal matter, entity internal matter. So it won't appear in the actual vendor account, but it will go to a vendor control account. So vendor control account will be debited and my exchange gain will get credited. So this is an similar entry if happens if INR depreciates or the whatever is the currency, euro, pound, Australian dollar, we feed these rates in the system and exchange rate difference gets automatically calculated on the balance sheet rate. So this one, this is called unrealized exchange gain or loss, right? So in this session, I am also going to explain you what is the difference between realized and unrealized. So first we talked about the posting. The posting will happen at the posting date. So that has happened. After the posting has happened, then there is a possibility whether my foreign exchange fluctuation will be realized or it will be unrealized. So when we are doing the revaluation, foreign currency revaluation, it is called unrealized. And now I'm moving on. Let's read number 13. Exchange difference arising on the settlement of monetary items on reporting an entity's monetary item. Monetary items are, for example, trade payable, trade receivables, at rates different from those at which they were initially recorded. Initially recorded, we talked about the posting date on which it was initially recorded. And then when it is settled, set by settled, I mean if there is a vendor liability, I am paying that vendor liability, or if I have done some export billing, so when I am doing the collection of the amount, that is called settlement. And when at the time of settlement, so what should happen? Let's read it. Exchange differences. Exchange difference means when I have done my export billing, at that time there was exchange rate which was there was 88 rupees per dollar. I have done my billing 1 month ago, and now the due date has arrived when my customer has to pay. And customer has like suppose there was a the billing was done for $10,000 multiplied by 88. So 8,80,000 rupees billing was done. Now, when he has paid me the money, my customer will pay me $10,000 only, right? So in dollar value, there is no difference. But the value of that $10,000 today, because today the exchange rate is 90. So it is 9 lakh rupees. So that means 20,000 rupees I have gained on account of foreign currency fluctuation. So now let's read it. Exchange difference arising on the settlement of monetary items. On reporting an enterprise's monetary items at rate different from those at which they were initially recorded. Initially, I recorded export sale at 88 during the period or reported in previous financial statements should be recognized as income or expense in the period in which they arise, right? So when I will get the money at 90 rupees, there is a 20,000 rupees gain. So what I'm going to do, I'm going to pass an entry. So in the first instance, I did customer account debit and sales revenue account credit. I recorded at 10,000 and 8 lakh 80,000. Now, money which I am getting in my bank account is 9 lakh rupees. So what I will do, I will do my bank account debit 9 lakh, customer account credit 8 lakh 80,000 because that was there in the customer account when I did the booking, and 20,000 rupees will go to my foreign currency gain. If it moves in the opposite direction, if suppose INR depreciates and it comes to 90.5 or 90.25, then correspondingly entry will be like I will get lesser amount in my bank. Instead of 8 lakh 80, I will get suppose 8 lakh 75,000 because INR has depreciated. So then 5,000 rupees foreign exchange fluctuation loss I will book and I will clear my customer. So there is a setting in SAP. We can see that setting also. We do that. So when the this transaction is settled or cleared, then the foreign exchange fluctuation get automatically recorded, and my vendor or customer account is also cleared at that time. So through the open item management. Sure. Then we'll move on. Okay. Anybody, any questions till now? I'll allow some time if anybody wants to ask anything.
Nothing fast.
Okay. Then we'll move on. Okay. Now, yesterday, some of you were there in my yesterday session. So, yesterday session, we were discussing there is one PPT which I have prepared. And in this PPT, I have covered all the balance sheet and P&L line items and how I have also explained the accounting treatment and the relevant transactions in SAP for those items. I'm going to continue with that slide only. So this slide is available on LinkedIn. You can all access it. So here, if I go to the P&L, I'll show you how any entity's P&L will look like. So in P&L, we'll see revenue from operations, we'll see expenses. So we'll see consumption of goods, employee benefit expense, finance cost. And then there is one component in every companies you will see, especially nowadays, all companies are involved in doing foreign currency transactions. They do purchase of goods, they do sale of goods outside India. So you see here, foreign exchange gains and losses is an item which comes in the P&L of any entity. Now I'm explaining this further. I'll directly go to slide number 49 where I'm explaining. So here you see I have covered in the initial paragraph, I have covered what is written in the accounting standard. So foreign exchange gain or losses are the profits or deficits that arise due to fluctuation in currency conversion rate between the rate prevailing on the date when the transaction is initiated and when it is settled. So now what we have learned so far that there are two types of foreign exchange fluctuation gain or loss. One is realized and second is unrealized. Realized means when I have done the settlement of the transaction. So my transaction is done. I have sold the goods, I have got the money. So that means I have my vendor or customer is cleared, or I have purchased the goods, I have paid the money. So it is done, transaction is done. The exchange difference, what comes at that time is called the realized exchange difference. But I have a open liability or open assets or asset in my customer account or vendor account, and at the month end or year end, I will do the revaluation because I am yet to pay that person or I am yet to receive the collection from that person. So in that case, that foreign exchange fluctuation is called unrealized because I haven't realized that money so far. I hope it is clear difference between realized and unrealized. It's an important interview question, so that's why I am emphasizing. So if you can talk about difference between realized and unrealized in a good way, like you are able to convey, then yeah, you will be able to answer that question in your interview very properly. Sure. Then moving on, certain transaction codes. So first is FS00. FS00 is creation of my GL account. So I'm going to create GL account for gain on foreign exchange, loss on foreign exchange, or it can be a single account also depending on your company's requirement. Some companies create a separate account for gain, separate account for loss, but some companies maintain a single account. That's also fine. Single account is also okay. Second is the control account. Entry doesn't go in the actual vendor account. It has to go in a separate GL account because you cannot do this entry in a vendor because vendor has nothing to do with it. So that is why we have to create a separate control account. Then OBA1 is the T code in which we define these automatic postings. Like uh, when the settlement process is done or when the revaluation is done, then system is going to pick the accounts automatically. right? And how it picks automatically, because I do one setting in OBA1. I'm going to show you that screen, and then we can learn from that screen OBA1. Then there are some transaction codes OB08. OB08, I maintain the foreign currency in the system. So there is a always there is a pair like USD and INR. I I record the exchange rate, the relevant exchange rate on that date. So this OB08 also we will see in the demo. Then there is one T code in which we can do the display, which is EWCT. So we can see what is the exchange rate prevailing on that date between any one pair of currencies. Then FAGL, FCVAL, this is the transaction where we do the revaluation at the month end or year end. And there are some accounting entries which are posted, which we will cover in the next slides. And there are some reports FAGLL03, FAGLB03. So you run these reports for your foreign exchange gain or loss accounts, and you can see what all transactions have been posted. You can double click the entry. You can further see whether it was related to a customer or whether it was related to a vendor. And using yesterday we were discussing document type. So using document type also we can find out that this foreign exchange fluctuation was for a vendor or for a customer, because when we receive collection from a customer, document type will be DZ, and when we pay to a vendor, then document type will be KZ. So exchange rate, this gain or loss will be booked at the document level when we are doing the clearing. So from document type, you can make out that this is a customer related or vendor related. Sure. Then we'll move to the next slide. So here I am explaining what is the difference between realized and what is the difference between unrealized. Now I have already explained you this difference. So we'll see one entry. Okay, so customer collection. So I'm assuming that previously I have done a sale to the customer for $10,000, and when I did the sale to the customer, at that time the exchange rate was 85 rupees per dollar. Okay, now my collection has come, and when the collection has come, then the exchange rate is 86. So what will happen? So when I record my collection entry and I will do the clearing of my customer, so bank incoming account clearing $10,000 and rupee term 8,60,000. So I am giving here two columns. One is amount in document currency, which is DC, amount in local currency, which is LC, and customer account credit $10,000 and 8,50,000. So why 850? Because the initial entry, which was I did when I sold my goods or services to my customer, was at that time exchange rate was 85. So that is why it is 850. And foreign exchange gain 10,000 rupees. This is when I do the collection entry from M-28. Then when I am doing a vendor payment, so vendor account will be debited 4,500. So now here I am assuming that a different exchange rate was there at that time. Okay, what let me quickly do this. I'll divide 4 lakh, sorry, 382 500, 382 500 divided by 4,500. Okay, so when I booked my liability for when I purchased the goods, at that time exchange rate was 85. But now exchange rate is 3,87,000 divided by 4,500. So it is now 86. Instead of 85, it is 86. So I have suffered a loss, because had I paid on that day when I booked my vendor invoice, I had to pay only 85 rupees per dollar. But now I have to pay 86. So that is why instead of 3,82,000 dollar bank outgoing, I have to pay 3,87,000 dollars. So I have lost 4,500 rupees here. So because we debit all the losses, so you can see here. So foreign exchange gain loss realized account is debited, and bank outgoing clearing account credited with actual exchange rate on that date, and vendor account is debited. So this entry is done from F-53 or F110. Moving on now, unrealized. Okay, before we go to unrealized, any doubts so far? No? Then okay, we'll move on. So now this is unrealized. So SAP performs this calculation very well. And there is a transaction code FAGL underscore FCVAL. Okay. So what SAP does is SAP will compare the closing rate which is there in my system against the rate at which my booking has been done, and it will calculate the difference between my closing rate and the rate at which the entries have been done. So you will say that there might be thousands of entries because in any large organization there are thousands of open items. And just one more thing here, we are doing the unrealized foreign exchange calculation only for open items. We are not going to do for any cleared item because cleared item is already zero. What I am going to revalue is the closing balance which is there, and foreign currency closing balance which is there in my vendor account or my customer account. So, right. So this is only open or closing balance. Now, closing balance can also comprise of a large number of line items which are recorded at different intervals, and they are recorded at different exchange rates. Some are recorded at 87, some are recorded at 86.5, because exchange rate will change on daily basis. Now it is up to me that I feed the exchange rate in the system on a daily basis, or I feed it on a weekly basis. It's according to my company's policy. But the thing is that there will be open item at different rates, and what system does is system will revalue each and every line item, open item which is there in my customer or vendor, and against if there are 1,000 items, yes, it will take those 1,000 items and it will calculate the difference between posting rate and closing rate, and it will do the revaluation. These are the entries which are done at the time of revaluation, customer control account. So it's not that customer account. Previously, when we saw in realized, it was the that respective customer or vendor account, because we I was paying or I was receiving the money. But here you see it is customer control account. Okay. And then customer control account debit if it is a case of gain of foreign exchange, or if it is a case of loss, then there will be debit passed in the foreign exchange fluctuation unrealized. So we will have separate GL account for realized and unrealized, right? So in that OBA1 that was there, we have the facility to maintain realized and unrealized GL account separately, which we are going to see in some time now. So here also we are doing vendor control account credit and foreign exchange loss, because it's a liability. So my INR has depreciated. So my liability has increased. So that is why I'm recognizing more liability by doing liability credit and expense debit. Now coming to my bank, I can have for the RBI regulations, they permit an exporter to maintain a export earners foreign currency account, EEFC account. Okay, so any balance which is there in my EEFC account is always denominated in the foreign currency. So it is used like if I do some export, I realize money in that account. So that money will remain in dollar or euro, whatever is my currency denomination. And when I do the payment, so I can do payment also in dollar. So it what the purpose of EEFC account is that it gives me a big flexibility that I don't have to convert my dollar into INR, because in future if the INR is depreciating, I am losing money. So I'll keep the balance in dollar, and after 2 months, if I have to pay somebody else in dollar, so I can pay from that account. So I am allowed to do that in India. So what happens? Similar to my customer and vendor, the EEFC or foreign currency bank account also I have to revalue. So similar entries are passed in the bank account also when I do the revaluation at every month. Now these entries which are there in for revaluation which are passed, they are automatically reversed in the next financial month or financial year, whatever. So it's a standard SAP functionality. System will pass the entry, system will reverse the entry. Okay. So this is all about some concepts, some accounting entries. Okay, anybody, any doubt till here? So are the concepts, everybody understood the concepts? Difference between
Yes, sir.
realized, unrealized. Yes, please go ahead.
Yes, sir. We understand.
Okay, that's very nice to hear that. Okay, and now I am again, I'll share my screen. Sorry. So now we'll move on to real SAP, how we do in SAP. Okay. So I'm going to show you the table where we maintain exchange rate. So the T code is OB08. If I go to OB08, then there is only one T code, OB08. And if there are hundreds of companies in my setup, then just imagine those hundreds of people which are there in different countries, because any large organization will have companies in multiple geographies: Europe, US, Africa, Australia. So there can be hundreds of pairs possible to for exchange rate. So there is only one table. So you will see large number of transactions which are coming in OB08 because everybody uses it. Now, what we can do is we can, when we go to OB08, so there is you open it, then there is one feature called selection by content. So we'll select exchange rate type. I'll explain you in a minute what is exchange rate type. And then we can also do from currency to currency. So we can select here the currency combinations. So exchange rate type M, INR to USD. And I will click on select. So right now you see there are 29,000 entries. But once I select this, then it will give me only those entries in which this I have selected. So only 14 entries are coming. Okay. So here you see, okay, now let's talk about exchange rate type. So there are multiple exchange rate types we can maintain. Normally M is the standard exchange rate type. Let us see the description of M. Description of exchange rate type M is standard translation at average rate. So all transactions which go in SAP, by default, they get converted at exchange rate type M. Okay. So now when I do the closing, or when the system is calculating the unrealized foreign exchange fluctuation, then closing rate, I am going to maintain at exchange rate type B, standard translation at bank selling rate. Okay, so you can, system gives you enough flexibility. You can create your own exchange, this exchange rate type, and then you can do the revaluation. Like for example, for revaluation, I want to use B, so we can specify that for revaluation, exchange rate type B will be used. But as of now, M we'll see. So all my recording of invoices, export invoices, all my banking, everything happens at exchange rate type M. So here you see there is a combination that 90.21 INR is equal to $1, or 89, or this rate was there on 1812, and on 1112 this rate was this 89.9. If I want to maintain a new rate, I can go simply select this. I'll click on copy, and it will copy one new line item. So I can put today's date, like today is 21. So I'll go here, I'll do 21/12/2025. And suppose the exchange rate today, sorry, 90 minute. Okay, yeah. So today, suppose exchange rate is 89.975. So I'll put here 89.975. I'll save it. Sorry, these are blanks, so it is giving some error. Okay, so if I go to this T code EWCT, so I'll do slash n EWCT. EWCT is where I can see the exchange rate between any pair of currency. So from INR to USD, 21.1. So this is what I have recently maintained, 89.9750. So it is coming here. And when I'm booking any entry in SAP, then entry by default, it will pick this rate. So we can have a quick check. We do FB60 here. So I'm just doing some test entry here. So suppose I'm buying something for $10,000. Okay, 10,000 USD. Let me delete these things. Hmm. So you see here, I have put 10/12. When 10/12 is my vendor invoice date, but 21/12 is my today's date. So here, if I see FB60, I'll go here and I'll click on local currency. So it shows me it has done the conversion at 89.975 by default. And it will book the vendor invoice at 899,750. So this is the sample FB60. So it is doing at that rate. Now coming to OBA1, we discussed about OBA1 in the beginning. So OBA1 will use this exchange rate difference open item GL account. So if I double click this, this setting has to be done at a chart of account level. So I'll go here, chart of account. So you can see at which GL account I want to maintain for doing the automatic revaluation. So this is the GL account, for example. From where I got this GL account, that also I can show you. So what we'll do is we'll quickly FB2, FB1N, and we'll run some open items in the vendor account for this company. So for example, this transaction was recorded, and here this is the vendor. In yesterday's session, I explained you that each vendor is tagged to a separate GL account. So here you are seeing the 1 minute. So you see here this GL account 200 200. This is the reconciliation account. Okay. So now when I do the exchange rate fluctuation entries, then this OBA1 I will do in this account only 200 200. So when I don't have to do at an individual vendor level, I have to do at a reconciliation account level. So here I can put the GL account in which system should automatically take the exchange gain or exchange loss. Now here you see this is what we are calling realized. Okay. And then here what we are calling in the second table, we are calling valuation. Valuation means this is we are talking about unrealized. So here we can maintain the GL account for unrealized loss and unrealized gain. And you see this one, this is the BS adjustment account, which in my presentation I was talking about. It was the vendor or customer control account. This is the control account. So it will be a different account than this, because this is the recon account in which my all vendor and customers are going, but this balance sheet adjustment account is something in which the exchange fluctuation will go. So referring back to my presentation, so what is this revaluation account? I am talking about this, which I have selected. So this is the balance sheet account, which I'm going to maintain in OBA1. Okay, moving back to the SAP screen. Yeah, here. So in OBA1, I'm going to maintain here the balance sheet adjustment account. Then translation, this is not much relevant as of now. So the screens which are relevant for you is the first one and the second one. Okay, anybody, any questions? Okay, if there are no questions, we will try one because this is the demo system. I get a lot of errors when I do. So, but I'll give it a quick try. Suppose this is my vendor liability, okay, and it was booked at an exchange rate of 90.21. Now today I'm going to pay this, and I'm going to pay at a different exchange rate. Let us see if system is doing based on the rate which we have defined in OBA1. Okay, so I will do USD. So suppose I am going to pay and the rate now 89.95. So I'll test, test, test account. This is my account number, $4,900 I'm paying. I'm paying it today, and I'm going to pay this person. Okay. Yeah, let us see that message what it was giving. We'll see it again. F-53. I'm going to do it again because I want to show you that message which we are getting. So system gives you an alert. And then there are some possibility to maintain tolerance levels. So suppose here by mistake, instead of 89.95, I am only putting 9.95, for example. Okay, mistake can happen with anybody. So system will give me an alert. If you see here, you see exchange rate 9.95 deviates from the table rate 89.975 by 88.94%. We can do some tolerance settings. And if I restrict this tolerance to 1% or 2%, then if I double click this, you will see there is an error message which comes. So this error message, right now it is yellow, right? Error message number is F5212. So it is coming yellow. So under the tolerances, if I can decide a percentage, if it is more than 5%, I can convert it into a red or error message. So it will not allow me to post the entry if the exchange rate differs from the table by more than 5%. So that system checks are there in the system. Okay, again, I'm changing to 89.95. I'll press enter. So you see this message has changed. Now it is saying difference by 0.03%, which is okay. I'll click on enter. So these are all open items, but I am interested only in the last one. So I'll click here. I don't want all these items. So I will deselect. I only want one item, which is this 4,900. And I'm now going to do document simulate. So at this stage, yeah, you can see here, system has automatically calculated this foreign exchange gain loss. Okay, I'll explain you further this how okay, it is asking for cost center. That's fine. We can give a cost because it's an expense, so it has to take an cost center. Now, very quickly, we will understand this entry. What is this entry? As of now, you are seeing this entry into dollars. Okay, 4,900 bank account credit, ITC retail vendor account debit. Okay, so giving you one background. So this is the entry. So this entry happened at 90.21. Fine. 90.21. But now I am making the payment at 89.95. So let me do a calculation. So it's a gain for me because when I booked the expense, it was 90.21. But now when I'm making the payment, it is 89.95. So 0.26 is the difference between these two. I'll show you here on calculator. 90.21 minus 89.95.26 multiplied by 4,900. So it is 1274. This is what I have gained on exchange fluctuation. Now, right now you are seeing this in dollar. If I click on this display currency, you will see this entry in INR. So you can see foreign exchange gain 1274, what we have seen in the calculator. We have seen 1274, right? 90.21 minus 89.95 multiplied by 4,900, 1274. So it has calculated the gain here. Clear? Now I'll also go here now. I'll show you. See, right now it is coming as an open item. You can see this is the vendor account. I can bring this column of amount and document currency also in my FBL 1N report. So here I'll bring it. You will see here $4,900. Okay, it is an open item. Now I am doing the clearing. So this is my realized exchange. So I'm going to post this entry. So okay, there is some error required in account. Okay, there is some error. So because which I am not able to post, but at least it is doing the calculation. Once I will do the setting, then it will also post this entry. And when it posts this entry, this open item will get cleared and the foreign exchange fluctuation will get booked. So these two things happen simultaneously. Anybody, any questions? So similar thing happen for customer, similar thing happen for bank and all other open items also we do in the same way. Okay, anybody, any questions? Okay, if there are no questions, then we can wrap up the session here. Anuradha, you can stop the recording. And feel free if you,